Does an annuity fit within my financial plan? And avoiding annuity mistakes that could cost you. Let's break it down on this episode of the Hawaii Retirement Show. All right, welcome everyone. Thanks for tuning in to this episode of the Hawaii Retirement Show. Today we're talking about whether an annuity would fit into your financial plan and also avoiding some costly mistakes around purchasing an annuity. So I think to start off, if you're going to decide whether or not it fits within your financial plan, there's kind of two things there. First is you need to understand what an annuity is, right? And not just understand, okay, it's a stream of income. You need to understand a little more than that, because annuities can be very, very complicated, and there's a lot of different kinds of annuities. And we'll kind of go into some of that here. And some of the verbiage surrounding annuities is kind of unique to annuities, right? So you really need to know what you're talking about and what to look for so you can make an informed, educated decision and not be left to the trust of your, either insurance salesman or your financial advisor. You want to understand what this product is before you decide to purchase one or not. The second part of that is you need to understand your financial plan and your goals, right? If you're going in and you don't understand what your portfolio looks at like and what you're trying to accomplish with it, then how are you going to decide whether this tool that is an annuity and all the different variations of annuities, how can you decide which one, if any, would fit in your financial plan, right? So you got to have a clear picture of what am I trying to accomplish? What do I have in place? And how does this annuity, whatever kind that is, fit in and help me achieve those goals or complete my financial plan? If you don't have a financial plan and you don't understand where you're going with your retirement planning and your portfolio, then there's no reason to go into the toolbox, right, to look for a tool of an annuity if you don't know what you're trying to fix or what you're trying to accomplish. Okay, so those are the first two things you got to figure out when you're deciding whether or not an annuity is right for you. So I think the next place to go would be to talk about some core principles around annuities. And what I mean by that is, let's go over the real basic, and I've done episodes on this in the past, and I've mentioned this quite a bit. But what is annuity trying to accomplish? And at its core, an annuity is acting as longevity risk. It's providing a guaranteed stream of income so that you don't run out of money, right? Because if you save this big nest egg and you have it to live off of and you might live until 100, if you turn on this income stream that is a true annuity, then you'll get those payments every month or whatever the frequency is for the rest of your life, no matter how long you live, so you won't outlive your money, right? That's why annuities are sold by insurance companies, because it's insurance. It's insurance that you won't run out of money, longevity insurance, right? That's why they're sold by insurance companies. So you can think of it as like a paycheck replacement. One thing annuities do by offering that steady stream of income is, they offer a lot of peace of mind. And I think that's what makes them very attractive to people, especially those who might not understand the full benefits to kind of a diversified portfolio with stocks and bonds, and you want something a little more safe. You like when the financial advisor or insurance salesman says, downside protection. You like terms like that. You like stability. And this does have a place there, and that could appeal to you. One thing I'll say is a lot of these annuities, they start mixing in, especially when you get into the indexed and the variable annuities, they start mixing in investments that go along with this insurance product. Life insurance can do that as well. But in my opinion, once you start mixing investments with insurance, whether that's annuities or life insurance, I think for the most part, you're overcomplicating things and you're incurring excessive fees because of it. So I like to keep things simple, right? The bank shot in basketball will always work, right? And so if your goal is investments and growth, then find a way to come up with a diversified portfolio that can achieve that. If your goal is longevity protection or life insurance, then yeah, you're going to look for an annuity or a life insurance product. When you start mixing the two, things get very confusing. The fees start to go up, and it just gets a little bit unnecessarily complicated. Now, there is a place for it. I'm not completely brushing it off, but overall, I think that's a good sentiment. Moving on. So another thing to keep in mind is annuities are a package. They're called a financial product, right? And they're packaged in different ways with branding, different companies. They have different names, the Defender or this or that, right? There's flashy riders. There's new catchy guarantees that change with the economy and depending on what kind of product they need. And so you just got to keep in mind that, these are always coming out with new bits, right? New shticks to them. And that's not necessarily a bad thing, but they're just repackaging the same kind of components with new caps or participation rates or, different surrender periods or whatever it might be into this new product, but it's essentially always the same thing. But just keep in mind that they're constantly being repackaged and sold by insurance companies. It's nothing new, and they will always change with the economics surrounding insurance and interest rates. So not a bad thing. Just keep an eye out that this stuff gets repackaged, rebranded into a new spiffy new annuity, and after you bought that one, it'll come out. It's like buying the new truck. Next year there'll be a new one that'll have some different features to it, right? So one thing I'm a big fan of, and I just want to put this out there before we dive into a lot of the verbiage and some other stuff with the annuities. One annuity that I'm a big fan of because it does achieve the stated purpose of longevity risk is a single premium immediate annuity or a deferred income annuity, right? So again, you got to know the verbiage when you're going in to buy one of these things so you can understand what you're purchasing. So single premium, right? Just one lump sum of money that you pay, single premium, and you get an immediate annuity, right? There's immediate and deferred. Immediate meaning that it's annuitized immediately, right? Because you can have a deferred income annuity where you pay, whether it's single premium or multiple premiums, and you're guaranteed an income annuity, but you're deferring the annuitization of that annuity, right? So there's single premium, varying premiums, and then there's immediate and deferred. So again, going into the different verbiage surrounding it. I like the single premium immediate annuities because essentially you turn over a lump sum depending on the interest rate environment and some other things around your longevity, your age and whatnot. They're going to do their insurance actuarial, calculation to figure out how much can we give you every year for the rest of your life, right? And if you die early, you might lose out. And if you live extremely long, then you make out in the end, right? It's just like Social Security. Should I claim early? Should I claim late? Well, if you knew the exact date at which you would pass away, then we could solve that specifically. But what you're trying to achieve here with these annuities, specifically the single premium immediate annuity, is you're trying to substitute for, you're going to get older. There's going to be possibly dementia. You don't want to manage the investments. You don't want to look at the market. You don't want to track the ups and downs. You just want to hand over some money and just know, okay, for the rest of my life, I got this paycheck coming in. And I think there's a ton of value there. Those types of annuities that I mentioned, they're not sold or pushed very often by the agents, with these insurance companies, mainly because they don't pay that high of a commission. They're kind of a plain Jane boring product, but I like it. Like I said, it's the bank shot in basketball. It solves an issue for you, and the issue is longevity risk. So another point on that is you can layer these things, right? You don't have to turn over, because especially if it's an immediate annuity where it becomes annuitized, that's an irreversible decision. You handed over money and they're starting an income stream. You can't go back on it. With the deferred annuities or the variable annuities, then there is some, you can kind of change your mind later to an extent. But with the immediate annuities, it is an irreversible decision. And another thing to keep in mind is the benefits of these annuities is highly dependent on interest rates, which are highly dependent on things like inflation and other economic factors. So one thing you can consider is layering these things. And what I mean by that is maybe you want to do $500,000 in an immediate annuity. Maybe you do $250,000 now, and another you wait and feel it out and do another $250,000 immediate annuity later. Doesn't have to be an all or none. You can kind of get your feet wet. Somebody could argue you might have got a better deal if you went all in on the initial annuity because of the interest rate environment or whatever it might be. Maybe, but there's also peace of mind in knowing that you haven't made any irreversible decisions. Or even with the variable annuities and deferred annuities, what I'll get into is their surrender charge, and they become kind of illiquid, even though there is still an option for you to change course. So consider laddering these things if you find out that it's a good fit for what you have going on. I just say do your homework, do your research, because a lot of times these things, and we'll get into a little more here, can get really complicated really quick. And I'm not faulting other financial advisors, or what I like to call them financial salesmen. There's good ones, there's bad ones. But a lot of times they don't fully understand this thing. They're going to hand you what's called a prospectus. And it's this little book that's going to be a doorstop. A lot of fine print. You're not going to read it. Neither did the person selling you this annuity. They glanced it over. They met with a wholesaler who told them about the annuity. And that's not necessarily a bad thing, and I'm not knocking them. I'm just trying to point out that these things are complicated. Take your time, do your homework, ask a lot of questions before you move forward. And like we said at the top, decide if it actually even fits into your plan or not. Sometimes, a lot of times, it might not even play into what you're trying to accomplish. And another big kind of overarching point that I want to make about these annuities is essentially what you're doing is you're giving up some gains, some growth, some upside. And in doing so, you're exchanging it for stability, right? And you're taking the burden of managing this portfolio of stocks and bonds and REITs or whatever else you have in there. You're taking that burden off your plate and passing it on to the insurance company. But you are giving up some growth and upside in most situations. Now, what the insurance company is doing is they're going to take the money that you hand over for this annuity, and there's some fees that will go into that factor into this thing, but they're going to invest your money, right? They're not sitting on the money in a savings account earning 2%. They invest your money for growth and upside. So they're going to take the growth that you gave up in exchange for stability. Not a bad thing. But if your goal is growth, then these things aren't really in large, the best fit for what you're trying to accomplish. Okay, so let's get into the tax considerations with these annuities, and this could be a whole series on just the intricacies of tax considerations that go along with annuities. So all I'm going to do is touch on some key points here. This isn't extensive. Again, these things get really complicated. Do your homework, but I just want to touch on the key points as it pertains to taxes and these annuities. One thing to keep in mind, you can purchase these annuities with qualified money or IRA money, right? Retirement money. Or you can purchase them with just regular, you have money laying around in your savings account. You can use that to purchase them. So there's qualified, non-qualified, right? And depending on the money that you use to purchase these, that'll kind of dictate in large part of how they're going to be taxed. Okay, let's go through some of these points. I had to write out some notes, otherwise I would get too lost in the weeds here. So let's start off tax deferred growth for deferred annuity. So when you put in money into this annuity, if it's not retirement account money, because that's kind of takes things in a different way. Well, even if it is actually to that regard, even if it is, there's going to be tax deferred growth, meaning you're not paying taxes until you take money out or you annuitize it, right? One of the two. So that can sound good when somebody says, hey, this deferred annuity has tax deferred growth. That sounds good, but you just realize you're kicking the can down the road because eventually everything gets taxed, right? It's just like a traditional IRA, traditional 401k. Take the tax deduction now, you pay it later. With these, you just get the tax deferred growth, but eventually rooster comes home the rest, you got to pay the taxes, right? There's no free lunch. So as far as withdrawals, and by what I mean by withdrawals, and again, this is where the verbiage really comes in, is a withdrawal is you're taking out part of the annuity. The annuitization or income is a different thing than a withdrawal, okay? And I know it's nuanced and it confuses a lot of people, and I get it. But it's good to understand the difference between those two. So for withdrawals, then 100% of the withdrawals are going to be taxed as ordinary income for qualified annuities, meaning the pre-tax dollars, right? You put it into a traditional IRA or a traditional 401k, you haven't paid taxes on those dollars yet, right? So all of the, whether it's gains or whether it's, distribution of a withdrawal of basis, it's all going to be taxed as ordinary income there. Now, for non-qualified annuities, meaning it's funded with after-tax dollars, then, and this could be, you paid the taxes, you had money sitting around in your savings account, and you use that money to buy an annuity. You already paid taxes on those dollars, right? When you earn the income. So with those, you're just going to be charged taxes on the earnings portion, okay? Not your own basis. Now, the thing to consider here is the IRS is going to use LIFO, last in, first out. So you're pretty much taking out your taxable gains first, and then you take out your principal, your basis. Okay, so if you start to take a distribution of $10,000 out and you put $100,000 in, and there was $10,000 of gains, that whole $10,000 is going to be the gains, the taxable part, before you get to the amount of your contributions, your principal there. Again, like I said, this tax stuff gets real complicated. I'm just trying to hit some key points here. Early withdrawal penalty still holds with 59.5. And then there's that, the 10% penalty. That still applies. There are exceptions when you annuitize these things or, disability or something like that. But the early withdrawal penalty will always kind of apply to these things. So taxes on income payments, and this is where we're talking about you annuitize it, right? Each payment is going to be partially taxable. So if you turn on an annuity, let's say you had a variable annuity and you let it sit for so many years and then you turned it on to be a income stream. So you're getting a payment every month. Part of that payment is principal and part of it is earnings. They call this the exclusion ratio. And so you're going to pay taxes on the earnings portion. And then once all the principal is recovered, right, and your annuity keeps paying out and you've already received back all of your principal, then the full amount just becomes taxable. There's a whole slew of things that happen with beneficiaries and passing these on, especially when you get into the 5-year rules and it's too much to dive into today. And I don't have this stuff memorized to where I can just, rattle it off. You got to really, I would have to double check because I don't want to speak incorrectly about, beneficiaries inheriting a qualified annuity because there's just, like I said, the stuff gets complicated. It's hard to keep track of every minute detail. But just know, if you do inherit this, then you need to speak with a tax advisor, a financial advisor, and figure out the best course of action for determining what is going to be taxed. And if there's a 5-year rule where you need to withdraw this, take out this whole annuity or whatever it might be. So I don't want to go any deeper on the taxes because, like I said, it just gets a little bit too much to wrap your head around, and it could be a whole series where I should really break it down and not throw everything out there all at once. A couple big mistakes to avoid when it comes to the taxes is you need to understand your annuity doesn't get capital gains tax rates. It's ordinary income taxes. If you invest this money in a brokerage account and you have gains, That's capital gains tax. If you invest this in a variable annuity and there are gains, it's not capital gains tax, ordinary income. Okay, the other big one is just remember 10% penalty applies if you're under age 59 and a half for these annuity, because these annuity products are designed to be retirement vehicles. And that's how they're looked at with the IRS. They're not meant for sort of a short-term buy and selling like a brokerage account would be. And so they're looked at as a retirement vehicle, and that 10% penalty for being under age 59 and a half will apply. Other big mistake is you got to know there's a lot of riders, and what that means is a lot of additional tack-ons and features that could involve lump sums or different things. And each of those can play a part in, factors that will affect the taxes. Okay, so covering a lot. I know I'm throwing a lot out there. Hopefully just a couple things kind of, you pick up in your head and you can use if you ever come across this, or at least something to ring a bell and you want to look it up. So a couple things. Let's say after all this, you decide, okay, I do need an annuity and I like it. I like the stability. I like what it offers. I understand there's, some downsides to it, but I like it. Okay, some things to consider is, again, like I mentioned, this is an insurance product sold by an insurance company. There are lots of insurance companies. And just like anything, mechanics, financial advisors, teachers, whatever it might be, right? There's good and there's bad, okay? And there's good and bad insurance companies. And what I mean by bad, I wouldn't necessarily call them bad. But what I'm talking about is the rating. How are they rated? They're going to have a rating of, I don't have it top of hand, but triple B or AA or whatever it is, right? An A-rated company, right? And what that rating is, it's showing stability in the company, strength in the company. And so, like I said, I don't have it handy, the whole rating sheet here. A quick Google search, you can figure it out. But you just want to look at, is this insurance company a highly rated insurance company? And usually you can tell by name recognition, right? I mean, all the big ones you've heard of, and they're probably not going anywhere. The reason that's important, if it's a fly-by-night insurance company, they sell you this great product and they go out of business, then you're just out your annuity, right? It's just gone. Their promise to repay you no longer exists. They're not in business. Okay, so we'll go through a couple traps kind of to avoid, like I said in the title here, some things that can really cost you. One, you just got to know the difference between fixed annuities, variable annuities, indexed annuities, immediate annuities, and then what are the risks and costs associated with all these things. And like I said, it's just important to know the verbiage. And if you don't understand the verbiage, do a quick Google search or ask your financial advisor or your insurance agent, salesman, whoever's selling you this product, explain to me what that is. What do you mean by indexed exactly? What do you mean by variable? Because again, the verbiage is the most important part. That's how you know what you're purchasing. But with these things, they can get a little more complicated, and it's not always so straightforward. Okay, number two, a trap you don't want to fall into is thinking that there's no fees, or being told, for instance, a big pitch with these is, you don't pay me anything, the insurance company pays me. That's what the financial advisor or insurance agent will say, which is true. You're not directly paying them, but there are fees baked in to where the insurance company has factored in the commission to the agent selling it, right? So you're not directly paying them, but there are fees. And we'll just go over a couple of the fees to look out for, and you want to ask this explicitly. Give me a full breakdown. Tell me what all the fees are associated with this product, so you can have a good understanding of how much this is going to cost you to purchase. Okay, first one is M&E fees, which is mortality and expense risk fee. And, they average a regular advisor fee, maybe it's like, 1%, somewhere in there. And that kind of covers the company's cost and risks, right? The insurance companies. There's investment sub-account fees, right? Just like your expense ratio for your funds that you hold in your investment accounts. You want to take a look at those because they might be higher than a typical expense ratio for that particular type of fund, right? So you want to know, okay, what are my M&E fees for this product? What's my sub-account or fund expense fees if this is a variable annuity or index, and there's some investments involved in this annuity. And then also you want to know, okay, with riders, right? Maybe you have a guaranteed lifetime income rider. Maybe you have a guaranteed minimum death benefit rider, or some sort of long-term care or enhanced benefit riders. Anytime you keep stacking these things on, there's fees associated with each one. And they can add valuable features to the annuity. But like I've been saying all along, it gets really complicated and hard to track. And, when you're in there in an office trying to purchase this, or you're thinking it over, it just sounds good to add these things. But you got to ask, okay, at what cost? And, a lot of times it might be completely worth it. Other times it might be very expensive to add some of these riders or add-ons onto your annuity. And then the last fee that's associated with these annuities is the administrative fee, right? The admin fee. And this is, it's typically pretty small, an annual flat fee or something, or it's a small percentage. But again, all these fees start to add on. You saw there's 4 different types of fees you might want to look out for. And even more if you have multiple different riders, and you got to tally these all up at the end and say, okay, how much is this annuity product, this financial product, going to cost me? Okay, is the juice worth the squeeze, so to speak? So that's the fees. The other part that's so critical to mention is there's a surrender period. And what a surrender period is when you purchase this, if it's an immediate annuity, like we talked about, it just turns on. It's an income stream. If it's a variable annuity or an indexed annuity, a lot of times there's a surrender period. And what it does, it sets up a schedule to lock in your money, right? Because they don't want you purchasing this thing and then 2 years later saying, I changed my mind, right? And so there's a penalty, which is outlined in the surrender schedule, and it's known as the surrender period, right? A typical one is about 7 years, I would say, maybe 6 to 10 years. And it declines over time, right? Because they're going to penalize you more if you take it out in the first couple of years as opposed to the last 7 or 8 years, right? So it might start as if you change your mind in year 1 and you withdraw your annuity, they might give you a 7% fee, year 2, 6%, year 3, it's 5%, and it just drops down from there. And what that does, rightfully so, they can't be, constantly selling these and then the person changes their mind. You got to kind of keep your money there. And that's why liquidity plays a big role in whether or not this product, this annuity, will fit into your financial plan. So keep in mind of surrender period and surrender charges. Ask your financial advisor or your insurance agent what those are, and you want to see a breakdown of it. So how long is my money locked in and what are the penalties if I withdraw it earlier? Okay, so another part is guaranteed growth. There's no guarantees. There's no guarantees. A lot of times you can hear the word guaranteed growth. I don't believe they're even allowed to say that, but you hear guaranteed. Always be very cautious and cringe if you hear guaranteed, because then they're lying to you. So there's all different verbiage that goes into and different rates surrounding the upside and the downside to these annuities. There's terms like caps or participation rates. How much do you get to participate in the growth? Or there's spreads, right? And these things can limit how much growth you actually get in that annuity. But like I said, you're trading it for stability. And that's why on the downside, there's things like the floor or the buffer, right? The buffer protects you, for losses up to a set percentage, right? And then there's a floor. So, you won't lose money, in a down year, whatever, beyond a certain amount, right? So you give up upside, but, you don't suffer the downside. That's the stability. So just understand there's caps, participation rates, and spreads on the upside, and there's floors and buffers on the downside. Try to understand what those are if those are part of your annuity. And another key part of that often gets lost in the shuffle or doesn't get brought up is that these participation rates, these cap rates, these buffers, these floors, they're subject to change. They're only good for the contract period, right? But at some point, if you hold on to this annuity, the insurance company can change these rates. They're not locked in. They're locked in for a period, but after that period, they can be changed. So what you were initially buying could be different. Let's see here. We're kind of running long. Just understand that there's high commissions with these. There's a lot of incentive to sell these things. They pay out pretty well, right? And you don't want to use just liquidity. Keep that in mind. Make sure that the money you're going to use to purchase an annuity is earmarked and can be used for an annuity. If a deal sounds too good to be true when you're talking to your financial advisor or an insurance agent selling you this, just know that it probably is, right? The old adage, if it's too good to be true, it probably is. Keep in mind that most of the professional sports stadiums around our country are named after financial insurance companies. Why is that? Because they're highly profitable through selling these products. I'm not saying there's not a place for them, and they don't serve a good purpose. They absolutely do. They are a good tool, but they're not here to hand you out the deal of the century. They're here to give you a fair shake. But when it starts to sound too good to be true, maybe look things over. See, am I missing something? Because they're not in the business of losing money. That's for sure. So I think that's enough for this episode. Like I said, these things get really complicated. We could talk for years about these things and all the different intricacies of them. But to kind of sum it up, make sure you know what an annuity is. Know what it is, know how it works, know what you're trying to accomplish. Be intentional with your financial plan and your retirement plan and your portfolio. What do I need? And if it turns out you need this type of tool, then start to look into it. Keep in mind, like I said, there's a lot of different verbiage. Take your time. Deferred, immediate, fixed period, all this different stuff, cap rate, participation rate. Just take your time, ask a lot of questions, and know that you can layer these things, right? You can buy one now and buy another one later. Don't ever feel pressured into making it all or none decision where you're going all in with these annuity products, unless you're completely comfortable and that's what you want to do. There's definitely pros and cons to these things. No doubt about it. A lot of pros. There's a lot of great things about them. I think my beef with them is they're often oversold to people who don't really understand them, most times don't need them, and the person selling them doesn't completely understand them, and they see green and commissions. Not all of them, but I've seen it quite a bit. And that kind of rubs me the wrong way, and that's why they give me the kind of a bad taste in my mouth. But there is a place for them. There is definitely a place for them. Just know how they fit into your broader financial plan. They're not for everyone. And there's always trade-offs, right? There's always trade-offs. If you want more of the upside and you want to be ultra aggressive with your investments, then you got to understand, okay, you're going to suffer some volatility and some hard times, some down times, right? What we're going through right now with this tariff stuff, right? The market is kind of at a low point. Maybe the thing is, you have a plan, you have your tools in place, and you stick to it, right? Oftentimes, the best thing I do for some clients is stopping them from doing anything. It sounds counterintuitive, but it is. That's sometimes the best thing I can do for somebody is say, hey, we have a plan. Let's wait it out. We got this covered. We thought this through ahead of time. We knew situations like this were coming, down markets, and we have a plan for this to get out of it. But a lot of these annuities, there's just a lot of different variations. Like I said, in my personal situation, when I start to get much, much older, way down the road, and I maybe start to, suffer some cognitive decline, and if my wife is still with me, then I'll probably turn to a single premium immediate annuity. and just to make sure she's taken care of, so she doesn't have to, figure out what's going on in the markets or go talk to somebody as a financial advisor, any of that. I'll just set it up so that I can put this single premium immediate annuity on, and she'll have a monthly paycheck for as long as she lives, and she's taken care of. Now, I'm not going to do that anytime soon because I'm in a stage now where I'm, 40 years old. I want some of the growth. I want to manage my portfolio. I can get ahead knowing what I know by managing a portfolio and managing distributions from that portfolio in retirement, and I'll come out way ahead. I don't need to pass on the burden of investments to an annuity company, to an insurance company. I can take care of that. I understand it. And a lot of people, they'll sit with their financial advisors, and their financial advisors can walk them through, what allocation of stocks and bonds and what the plan is, and they can walk them through so they can experience more growth. Some people are risk averse. They can't stand volatility. They don't fully comprehend the markets, and they're a little bit, scared of the market. So they might be scared of, geopolitical risks or something, right? And that I get. And like I said, I'm not trying to dissuade people from these. They are a tool. But I just want you to understand there's trade-offs. And when you do this, you're giving up growth for stability. And there's fees baked in. And you need to understand what you're purchasing. Take your time, ask questions. Okay, hopefully that was helpful. I know that was a lot and I ran on and on here. But if there's anything in particular you'd like me to talk about on the show going forward, email it over to aloha@hawaiiretirementshow.com, and we'll catch everyone on the next one.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.